Okay, Junior, you got your mic muted, but welcome. If you want to join in at any time, please unmute and ask your question. But we're going to get started on our questions tonight. We have with us the one and only Mr. Brent, who is our technical advisor and producer of today's program. I'm Rick Roller, longtime real estate instructor, and since 1980, and longtime real estate broker since 77. But more important than that, I'm the guy that gets you through the test. My number, 801-556-8000. If you have any questions, Junior, you're welcome to call anytime. And a few others are now chiming in. You're all welcome to call in anytime. I get people a call and they say, hey, I can't believe you answered your own phone. Well, I gave you the number. Yeah, just call. Well, then I have people that text me and say, is it okay if I call you? Why would you do that? Just pick up the damn phone and call. Okay. If it's not appropriate time for a call, I won't answer the phone. But most of the time I just answer the phone, guys. You don't have to do not text me. Call. We'll spend a quality 2, 3, 4, 5 minutes on the phone. I'll answer your question. You'll understand it. It's like magic. So tonight we're going to be doing some work on finance terms, and different types of aspects that you will probably see someday when you're standing or sitting in front of a computer screen trying to pass a multiple choice test. Okay, fair enough. So let's get with number one. A subordination clause in a loan would involve which of the following actions? A subordination, the act of that. Okay, what would that clause do? Would it assign a new borrower? Would it alter? Is it an alteration of priority? Which that's the right answer, by the way. Or C, abandonment by the borrower or abrogation? No, it is alteration of priority, B. So let's highlight that one, Brent. There you go. Appreciate that. Subordination clauses are very common if people buy lots and then they want to get a construction loan later. And when you're buying a lot, sometimes you can get the owner of the lot that you're buying it from to carry a little bit on the mortgage or the purchase price. So maybe put half down and he carries half. But sometimes you can get them to agree to subordinate to a construction loan, which means they would be in second position, not first. So the change from first to second, we actually go through a process to do that, but a subordination clause allows that to happen. You alternate the priority. Priority meaning what's first loan, second loan, and whatnot. Number two, please. Let's go, Brent. If the loan to value ratio is too high, the lender will want mortgage insurance to protect its interest in case of a default and foreclosure sale. In most all cases, what is the number that triggers mortgage insurance being paid? It's not 95, 90, or 75, guys. It's anything less than 20% down, which would be an 81% loan, because that's only 19% down. So even though you're only just 1% off, you're going to be faced with the necessity, because the lender won't give you the money unless you do, paying additional money on a monthly basis and probably some upfront for your mortgage insurance premium, which makes it much nicer if you could wrangle it around somehow to where you're putting at least 20% down, and that the lender is not putting any more than 80% into a loan. It'll make your payments in the long run much cheaper. Number three, in order to obtain underwriting approval for a federal FMMA loan with the value to ratio of 90%, what must an applicant have? Once again, this is related to our previous question. It's primary mortgage insurance, A. Business interruption insurance, that's insurance that said, like, if you had a fire, we recently had a horrid fire in Sugar House that took out an apartment building that was being built. Now, the people that are putting that together may have had business interruption insurance. I hope they did, because that means they planned on being ready to go and put tenants in at a certain date, but they couldn't do it. So the insurance company will actually insure that loss of income stream. But the right answer to this one, of course, is primary mortgage insurance. Flood insurance, no. Homeowners insurance, they all require homeowner insurance. If the house burns down, they they want you to contribute most of that to their loan, if not all of it. Number 4, please. Okay, which of the following is a trigger term as stated in Truth in Lending pamphlet given to a potential borrower? Make a note to yourself that lenders have to give these pamphlets out anytime anyone applies for a loan within 3 business days. And it's called You and Your Mortgage or Your Mortgage and You, but it's just a very standard government pamphlet. Go get one from a lender. Lenders will be contacting you anyway. Boy, I sure would like to help you follow your business. Say, well, I want one of those Truth in Lending pamphlets, and then read through it. What you need to do in our business is you need to immerse yourself in the process, not just get a 70% plus on a multiple choice exam and get your license, but you need to learn everything you can. Because these questions will come up, and a trigger term is something that applies to the ads that you put together on your particular listing or another listing you may be advertising for someone else. And a trigger term says that there are certain things like the payment. If you mention the payment, then if you give one of the terms, which would be a payment, then you have to give all of the terms. Now, if you give a vague payment, like you say, hey, payment's lower than $1,000 a month or payment's lower than $1,500 a month, that's vague. But if you say it's $1,338, then you have to give all the terms. The only term that you can advertise independently is B, APR. But this question says that which one of these terms, loan, price, it's not the price, it's not, you're getting a VA or an FHA loan, and it's not APR because you can advertise that one independently. But if you give the payment, then you have to give all the term. It's a trigger term. So when you write ads, be very careful to be either vague or be prepared to just put in the APR, and that would be fine. Let's go to number 5, please. Thank you, Brent. Okay, which of the following statements is true of both Truth in Lending and RESPA, Real Estate Settlement and Procedures Act regulations? They cover single to 4 family dwellings. APR must be used in advertising. That doesn't apply to both of them. It only applies to Truth in Lending. The book Settlement Costs You, the booklet Settlement Costs You, that's the one I was speaking about earlier. That's not a RESPA requirement. It's a Truth in Lending, and they can cover loans to small businesses. They don't cover commercial loans. So that leaves us with A. They cover single family duplexes, triplexes, and fourplexes. And anything above that, they consider that more of a commercial type loan. Number 6, please. Which of the following entities is only in the secondary mortgage market and not in both primary and secondary? Well, banks, insurance company, and private individuals, they're in both. They make direct loans. So that would be Ginnie Mae, A. That's the only one that does secondary only. It doesn't do primary loans. They buy packages of loans. And that's what they're there for. They're there to create more liquidity in our mortgage market. And they've done a pretty good job of it. Right now we're seeing a lot of people that are being faced with the fact that it's difficult to get a loan. But that's because the rates have jumped up to the point where, qualifying is much more edgy. You're going to be making a lot more money and less debt and whatever else. But Ginnie Mae's still out there buying loans, and that's a good thing. Let's look at number 7, please. In a VA loan, the VA lends money and the lender guarantees. B, the lender provides money and the VA insures. C, the lender provides money and the VA guarantees. The VA provides money wholesale to the lender and the lender makes a loan. Insurance is an FHA thing. They're the ones that insure, not the VA. So that eliminates B. VA doesn't lend money, so that eliminates A. And D, the VA provides money again. No, they don't. So VA mainly, they just they guarantee the loans. And it's because of veteran service in the military. It's one of the benefits that they get for defending our country at home and abroad. And it's just one of the perks that they get. And there are a lot of folks in Utah that have done military service of one kind or another, even quite a few that have been in the National Guard. And even being in the National Guard in many instances can qualify you for a VA loan. And it's a great way to get financing because they can get in with absolutely no money down, and they are great loans that the Veterans Administration looks after their veterans really, really well. Number 8, please. Okay, L agrees to carry a second loan in the sale of a home. It was for $20,000, 9% interest, 30 years payment of something or other. However, it had a 5-year call and the buyer would pay off the balance of $19,176. How would you describe this loan arrangement? Well, if a loan is a fully amortized loan, it means you make normal periodic payments over a period of time that retires the loan, equal periodic payments. That'd be fully amortized. Well, in this case, you're making payments of $160.92, but then there's a balloon. So there's one payment, well, it's over $19,000, that is higher than the other payment. So it's not fully amortized. It's not a wraparound because it doesn't include 2 loans, it's just one. And it's not a discount loan, and so that would mean it's partially amortized because you didn't pay off the whole loan over the life of the loan. There was a balloon in it. And it's very common. It's very common. Something that your buyer is going to have to watch out for. Number 9, please. E borrowed money from a bank for personal reasons. It had a fixed interest rate for a 5-year term. Monthly payments were IO, interest only, and at the end, E owed the lender the full amount borrowed. What kind of loan do we call that? Well, that's called a straight loan. C. A straight loan is a loan that you make, you only pay IO, you pay interest only, and then at the end, you repay all the principal. It's not a purchase money. A purchase money is a type of loan where you're using it to buy something. Well, this was for personal reasons, like a personal loan. It's not a participation loan. Participation loan is when the bank gets so greedy, they not only want their interest rate, they want to participate in the equity accumulation and the appreciation on the home. And it's not a partially amortized loan either. Okay, because there was no amortization. There was only IO. There was only interest only payments, and we call that a straight loan. Now you're seeing here that in a number of these questions are all definitional. So it's very important that you learn these terms. And I'm telling you now, there's about 300 to 400 terms on the real estate test that if you don't know what they mean, you're cooked. So please spend some time with vocab and work on some vocab. I have a vocab program that you can call in the office and get, or it'd be best to call me. I'll send you the link, but it's a Quizlet program. And it has some different exercises in it. The best is, what I'd recommend is the flashcard game, where you'll see a definition and then it will give you the term, or it'll give you the term and then give you the definition. But it's a great way to learn these terms. And I know that the ones that are in my program are what you're going to see. So if you want that, there's no cost to it. Just get a hold of me. I'll get you a copy of it. Let's look at number 10. Which of the following terms is not applicable to an ARM, an adjustable rate mortgage? Well, what is applicable is there's always a margin, there's always an index, and there's always a cap. What there isn't always is a discount, like discount points. A margin is that amount over, that you pay over the index rate. The index rate is, there's a number of financial index out there. And a cap is how high it can go, and can't go any higher than that. But you don't have to have a discount. So that's not applicable to an ARM. Number 11, R wanted to buy Q's home, and being new on the job, didn't quite qualify. Q agreed that with $15,000, and there was an existing loan also on the property, Q would carry a loan for the remainder of the purchase price, amortized over 30 years at 8%. This is a great example of a wraparound, because you're wrapping around. It's like a burrito. You're wrapping around all that goodness. Well, in this case, you're wrapping around an existing loan. It says right there was an existing loan on the property. So now there's 2 loans. There is the existing loan and the wraparound. And the wraparound probably includes that other loan. And so what I'm saying is that the seller had some remaining equity that the buyer couldn't buy out. But the seller is also taking advantage of the fact that his existing loan on a property was probably much lower interest rate than 8. So by wrapping that loan, let's say his old loan was 4%. Well, he's going to make 4% on money he's borrowing at 4 on the existing loan, because the new buyer's paying 8, and then he's going to make 8% on whatever equity he had left. So, you got to calculate that out depending on what the ratio is. But in essence, it's going to increase his yield higher than 8%. It could be a very good deal for both of them. One, because, well, it's the only way R could buy the house. And two, Q's going to make some extra cash flow out of the deal. Probably a good thing to do for both. Number 12, seller has trouble selling a property because they have a due on sale clause in their mortgage. They don't want to have to pay the balance. They found a buyer that's willing to assume the loan, and they draft 2 contracts, one to sell they draft 2 contracts, one to sell the property and another to show the lender so that they don't know the property's being sold. They invite the agent to a transaction broker for sale. What the heck should the agent do? This is really a bad thing, because look at D, that's your answer. Anytime you hide something from the bank, you're going to get in big trouble. The commission would come down on you and say, this is a double contract. Okay. Errors and omissions insurance, E&O insurance does not cover fraud. If you did this, you committed fraud. So they wouldn't cover any losses on this. I mean, they're supposed to be honest and forthright in your dealings. E&O insurance was not instituted to protect crooks. Choose either buyer or seller to represent, not both. Now hide the transaction from their broker. Heavens no. Number 13, please. Here we go. Okay. SO's $500 to P for services rendered, and P $450 to S from a previous transaction. So S owes money to P, but then P owes money to S. So they decide to resolve the difference and just have S owe $50. In other words, they're going to credit the lower amount to the other, so that you only have to pay the set off. So it's called a set off. It's not a lease agreement. It's not foreclosure. That's not insider trading. It's a set off. Because what happens in a set off is that, well, I owe you some money, you owe me some money, but I owe you more, but what you owe me, I'll take as a set off, but I'll just pay you the difference that I owe you. It's much simpler. Okay, go to 14, please. What kind of title? In fact, I've never seen a set off on the test, so I don't know. We'll see if it's on there or not. 14, what kind of title insurance would provide the most protection for a buyer of the property? Well, guys, it's the extended owner's policy A, and that's the one our contract calls for. It's the one that says that if it's available, then the seller would have to provide that to the buyer. Now, one instance where it's not available is if you're selling vacant land or lots. Extended owner policies are not available for just lot sales. But if you're buying a new home, even an old home, that's the one that they want, because it gives them the most coverage. Plain language policy is good. Alta's lender's policy is good. Standards policy is fine in most cases. But if you want the absolute biggest bang for the buck and stay in compliance with our contract, they're going to get an extended owner's policy. Number 15. The purchase offer for a property is signed, and after the title insurance is revealed, there are 2 liens outstanding on the property. Which is true? Okay. When you get out there in the real world, it's extremely important that you get your title insurance commitments ordered early. Now, many agents delay this. This is foolish and not something you should do. But sometimes agents forget, or they don't know, or they're kind of naive or new, and they haven't done many transactions. But if you listed a property, the first thing I do is I call my favorite title company and order a title insurance commitment. Now that means that if you get that deal put together, you're going to use that title company. So you get permission from your seller that's okay with them. We actually include this in our listing agreement. It says that, they agree to let us order that immediately. Why? Because you want to know what liens and problems there are with that particular property. Because the seller is responsible for all those liens. And a lot of times the seller will say, well, I had a second mortgage. I had this come up a number of years ago. It was a property on 39 South and way east, almost on the bench, but not quite. But when the buyer bought it, who now became the seller, and she lived there about 10 years, and then she wanted me to sell it for her. But when she bought it, acquired it, there was a little owner carry loan. Well, she'd paid that off over the years. And so when I pulled the title commitment, the lien was still on there. And I said, what's with this? She says, well, I paid that off. I said, well, what did he give you to indicate that you'd paid it off? Well, he sent me back the note with marked paid in full on it. The actual promissory note that she'd signed. Well, that's not good enough. What we need to do is get a deed of reconveyance, which is the payoff document that you have for a loan. Now, it didn't, the problem is that, after 10 years, you don't even know if this seller you bought the house from is still alive or not, or where they are. That they don't send you a Christmas card every year and say, well, hey, we moved from Miami to Texas, and here's our contact information if you ever need us for anything. They just don't do that. Well, unless you got real friendly with them, but that doesn't happen very often. And so what happens is I had to hire a skip tracer to track these people down. Luckily, they were still alive. I explained to them what happened, that just sending that note marked paid is not enough. And they said, oh my goodness, well, what do we need to do? I said, we're sending you documents, take it to a bank and sign it in front of a notary and send it back. And they did, and we got it recorded. Now, this was all handled within the first 2 or 2.5 weeks of having the listing. Most title insurance problems can be handled within about that period of time. There's not a lot of things that would cause so much damage it's going to make the house unsaleable, although it could be. So for 2 reasons. Number one, since most title insurance issues can be solved up front if you know they're there, that's one of the reasons why you order it immediately, so you can track all this stuff down and get it cleaned up. A good agent anticipates problems and then solves them before they become a problem. This was all cleaned up before we even had our buyer, okay? That's what you need to do. A poor agent waits to the last minute and then orders your title insurance commitment and then finds out there was a problem and has to have to extend closings, or maybe you lose your buyer, or the buyer loses the lock on their loan. It can be all kinds of headaches and responsibilities and problems. And the seller's responsible for all that, okay? The buyer and seller won't equally share this. This happened before the buyer even came along, and glistening liens are eliminated when the property sells. Oh, heavens no. That's why we have the title insurance company make sure they're all paid off. And the buyer is solely responsible to satisfy the liens. That's ridiculous. He didn't create them. He shouldn't have to pay for them. Okay. Okay, number 16. Which of the following is not a true statement about the settlement statement? Okay. Not. See how not's all in caps? That's the way it's going to be on your exam. They're not going to try to sneak in a negative that changes the whole direction of the question. This is a negative question. They want to know which one is not a true statement about settlement statements. A, it is to account for all the money involved in the transaction. Yeah, well, that's what it's for. That's true. B, it will note if monies were paid up front, like earnest money and whatnot. Okay, that's true. C, the seller's loan payoff will be a debit to the seller and a credit to the buyer. That's not true. Okay, that's our answer. And I'll explain that in a moment. D, the buyer's total cost appearing on the back and front of the statement. Okay, that's true as well. Now, the seller has an existing loan on their home, and let's say it's $25,000, and those are unrealistic figures. Let's say it's a $250,000 loan on a $500,000 condo. Okay, it's half paid off. Okay. Um, the buyer's paying $500,000 for that condo. Now, how he's paying that, maybe he's paying all cash. I don't know. Most likely he's putting down hopefully 20% to avoid PMI, private mortgage insurance, and he's getting 80% loan. So he's getting a $300,000 loan. Okay. Well, that's the buyer side of the transaction. On the seller side of the transaction, seller wants to net some dough, and he's going to come out real sweet on this deal because he's got it half paid off. So after your fees and the other fees involved with the closing and paying off that existing loan, seller's going to get that money left over. So this has nothing to do with the buyer. Okay, there's a buyer side and a seller side. So what's wrong with C here is that the payoff will be a debit to the seller, but it has nothing to do with the buyer. Now, there are some things that do affect both buyer and seller, like the property tax. Now, the property tax in our state is paid, as we roll into the Christmas season. People are paying it, usually the banks pay them in November, but no later than December 1st. And so, as we're rolling into the Christmas season, and of course, you've been making payments on that or escrow deposits usually, to your bank. So your payment is PITI, principal, interest, taxes, and insurance. And because the bank wants there to be money for next year's insurance policy, but they also want there to be enough money to pay the property taxes. Because the truth be told, their lien is not really a first mortgage. It's really second behind the property taxes. Well, the bank doesn't like to be behind anything or anybody. They want to be in first position. So but you can't. I mean, the property taxes are legislated into being. They're under the dirt for everyone, unless you're a church or something. But anyway, the thing is that so what happens is they usually set up escrows. And so you make your payment and you pay the bank a little extra money to pay for next year's insurance and this year's taxes, which accumulate throughout the year. Okay. So on that one, there would be a debit to the seller and a credit to the buyer. Because if you bought the property, my gosh, this time of year, the seller's going to have to ante up almost all the taxes. I mean, you're only going to have to come up with a month and a half or something. So you will have a settlement statement on the exam, but don't freak out. It's like a crib sheet. We have samples of what they look like, and you need to get them and go over them. There will also be a real estate purchase contract that's filled out on the exam as well, and a number of exam questions that are asked in regards to that contract. I mean, what's included, what's not included? Is the seller paying discount points, or is the seller contributing anything to the buyer's loan? That type of thing. Well, that's all in the contract. Be careful. I really admonish you, please get a copy of our sample agreements and read the RUPC at least 4 or 5 times. Not so you can memorize every specific section, but you kind of get familiar where it is. Because remember, this is a time pressured exam. So what'll happen is those settlement sheets and that real estate purchase contract are fantastic. It's like they gave you a crib sheet, an answer sheet to the question. But there'll be a question that'll say, okay, did the seller contribute anything, or what personal property was included in the transaction, or whatever the question is? If you have a basic familiarity where those sections can be found, like the dates are always on the last page, okay? Then, you know to go quickly to the back page and you find the answer quickly and it's there. Now, be careful though on some of these terms, because look as you go through the one that they give you to look at, the real estate purchase contract. Look very carefully to make sure there's not an addenda. If there's an addendum, what happens is you were a dummy, because you need to read that too, because that could change something. That could have been a counter proposal where the buyer said, well, I'll pay you this much money, but I want you to pay $5,000 in closing cost. Well, you won't see that in the offer, the original offer. It'll be on the addendum. So they'll change something, or they'll say, well, I'll pay you $1,000, but on the dollars. So read all the or scan them, real quickly. Okay. Okay, let's look at number 17, please. On the settlement statement for a property closing on March 16th of the year, a proration of property taxes would appear as, okay, property taxes, like I said, are paid in arrears. You're always paying for the year that was. Someone that's closing on March 16th, right about the middle of March, that seller is really responsible for January, February, March, half of March anyway. Now, what'll happen is that that seller has about 2.5 months of property taxes that he's already accumulated against that property. So it'll be only fair that he should give some money to the buyer so that when the buyer's bank pays that in November, that that money was contributed by the seller for the seller's share. So credit seller, C and D, no. This would be a debit to the seller because we're taking money from the seller. But debit seller, debit buyer, that's two debits. It's either going to be contrasting. So we're going to debit the seller and credit the buyer. Okay. And that's called a proration. And the title company is going to figure that all out. And so on the settlement sheets, there will be a debit from the seller and a credit to the buyer. But then the bank's going to take that credit to the buyer and snarf that and put it into an escrow account. Okay. Okay, does anybody have any questions about anything we talked about tonight or any other topic? Chime in now and ask them. And go ahead and clear the screen, Brent, if you want. Okay. Okay, well then I'm gonna end tonight. I know this has been a whirlwind, but I know you're all anxious to go see what's happening with the election.
Thanks for your time, Rick.
Lindsay, do you have any questions about anything?
Not just now. I need to just study up on things. I'm a little behind. We caught COVID, so I was actually able to sit and listen.
Okay. Well, I'm glad you're over that, right?
No, I'm in the middle of it.
Oh no, I'm so sorry.
Yeah, so it kind of hunkered me down and I'm able to get some things done I wasn't doing. So
yeah, sometimes you don't feel like doing anything.
Yeah. Yeah. I appreciate your time though. Just want to let you know.
You're very, very welcome, and call anytime if I can help you. Sean, have you got a question, or Ringer, or anyone else? Okay. Well, let me leave you with this thoughts for successful living. Okay. You're always looking for the key to success, question mark. It is to be found only on your own person. You're always looking for the key to success. It is found only on your own person. In other words, you are the cause of your success. It's not someone else, it's you. Sometimes you're just in the right place at the right time, and sometimes you're not. But you guys can make this work. We're entering into a down market, and actually good realtors make more money in a down market. And there's several reasons why. This last down market we went through was 08 area. I was in that time frame. I was on the board of directors for the Salt Lake Board of Realtors, and we watched our membership drop from 8,000 agents to 4. And that's one of the reasons why you can make more money after your competition quit. Okay. But the problem is a lot of these competitors of yours aren't really true competitors. Okay. They're just kind of skimming off the cream at the top. Like they'll do 4 deals a year and it's to all their relatives. Who wouldn't list with their brother-in-law, especially in a market where everything sells in 3 days and sells for 50 grand more than what you're asking. I mean, it's not hard to sell a house, right? But in a down market, those people leave because being in the board is expensive. I mean, and they're not going to get their 4 deals because the market's slowed down. But the people that are still buying are real serious. you know, and a lot of them are rolling into our community with a lot of money. A lot of people coming in from California still. When things get bad around the world and the country, a lot of people come home to Utah. I've seen it
Yeah.
happen many, many, many times. And so they just feel safer here. Or, well, let's go home. What do you mean home? We've loved living in California. I know, but this isn't where the grandkids are. Home is where the grandkids are. And they pick up and they move and they bring millions of dollars in their bank account with them. And a lot of times they just pay cash. Those are great buyers to work with, you know, and there's just a lot of opportunities. Now, this time around, we've seen foreclosures just this last 3 weeks. We were looking at foreclosures being at about 50 to 150 a month ish, right in there. This last few weeks, they've exploded almost to
Oh,
700 this last month, 680 something new foreclosures.
oh
Well, that's
goodness.
an opportunity for you because a lot of these, unlike before in the 08s when we had to do tons and tons of short sales, which, you know, I did 150 of them, about drove us all crazy, but we got it done. But what happens is people have equity, actually. You know, maybe they've lost their job, maybe they've lived foolishly, you know, maybe they're getting divorced. I don't know. But the thing is they need to sell that property for one reason or another, and they still have equity, even though the prices are, you know, kind of shrinking a little bit. They haven't shrunk to the point where if they bought this property 4 or 5 years ago, they still
Right.
have substantial equity, but they're also in foreclosure. So, you know, that's a list you can work. You can have your lender pull up all those people, you can get it, and you can go talk to them. Okay. What I would suggest you do is develop a little postcard with a QR code on it that would take them directly to you speaking to them. And it would, you know, so it's this, if you don't let the bank take advantage of you, watch this short video. They pull out their phone. Everyone knows how to use a QR code. It's what we had to do for menus during COVID. Okay. And so they hit that QR code and it's you. It takes you to you immediately. And you say, you know, there are many things you can do. I know you're faced with a problem and you probably are asking yourself, you know, I don't know what's going to happen next. Do not let the banks take advantage of you. You know, let me come out and talk to you. We can examine your situation and figure out a way out of the situation that you're in. And you may have equity that you don't even realize you have. You know, so you kind of just give a little bit of heartfelt, you know, who you are and why you're doing that. And then because a lot of them won't answer the door. A lot of people are in trouble, they just won't answer the door. So if you have a little
Yeah.
poly bag or you have this card with rubber band stapled to it, you can put it on the door. And I would suggest you dress down a little bit. Don't look like a banker. They'll yell out the window, get the hell out of, you know, you don't want that stuff going on. So but that's a list you could actually work if you want to. You know, that's what we did. We just knocked on their doors. Some would answer, most would not. And then we drive around the block and yeah, they already opened the door. And what we were doing back then though wasn't QR code. It was actually a CD, and it had my wife who had a license at the time on it, and another gentleman I was working with to put all those short sales together. So we were working as a team, but it worked very well. You know, I mean, sometimes they'd call us immediately and say, yeah, you know, can we talk to you? You know, you just have to let them know you're on their side. And that's another
Yeah.
thing you can do. Another thing that you might want to do is you might want to work out of town owners. Out of town owners are people that own a property here, but have their tax notice sent to another property in another area. Yeah, the biggest one's California, and then Idaho and Arizona kind of run neck and neck. But those are the 3 states where people who own property here and they don't live in Utah probably live in. And the reason I like out of town owners is because they don't know an agent in Utah anymore. Sometimes these properties were inherited by them. It was mom or dad's property and they passed away. They've been renting it out for a while. But now they're hearing that the market's kind of, you know, collapsing a little bit, and maybe they got to sell now while the market was still really high. And if you work with people that are absentee owners and they live in Sandy, but the property's in Sugar House, they they probably have a cousin, brother, uncle, mother who's an agent, but if they're living in California, they may not, Idaho or Arizona, and you can get that list from your title company and start corresponding with them. Another one is I believe every listing ought to get you another listing. And so what you do is you work the geographic area around the listing you just got. One of my young ladies that I'm mentoring just had her first sale, and it was a condo up in Bountiful that we got for her. We helped her get, and it was an estate sale, which is another thing you can work because you can get that list. This one was actually owned by a buddy of mine who's a broker in Nevada. It was owned by his wife's mom who died, and he called me and said, let's give it to this agent. And they did. And so we did that one. But what I encouraged her to do was to work the condos around the condo she listed. And what you're working with is a just listed card. Now, if you're tight in your budget, you can do this with flyers in the doors. Hey, I just listed this condo in your association. Here's all the information on it. And then an open house invitation. That's 2 touches. And then maybe a price reduction, which in this case we didn't do. And then the last one would be just sold. So she had 3 touches with them, and you can get you can actually get a geo list that has their phone numbers on it as well, and you can call them. But I suggest you get them a card or a printed thing. You can leave it on the door or mail it to them, and then you call them, hi, did you get my card, and that kind of thing. But that gives you a lot of touches. You 3 by phone minimum, maybe 4, and maybe they came to your open house, you got to meet them. But they know you're working the area, and they know you sold one in that area. I mean, actually this one was sold by another agent, but they never figure that out. I mean, so the point is that, hey, I developed this great marketing, and we have additional buyers that are still wanting to buy in this area. If you're thinking about selling, now's a great time, and here's what we got for the one we just sold and whatnot. So these are things you can do. There's about 8 or 9 things I could sit down and talk to you about, but what I'm saying is yes, you're going to have to work. Now, hey, the agents that'll do the best in this market are the agents that actually endear themselves to the bank and get the bank listings. I mean, they're going to give you 5 or 6 listings a month. Okay. But as the market we're into, where you could have made, 100, 200 grand a year pretty easily with just, 2 or 3 listings at a time, you're going to need about 8 to 9, 10, 12 listings. Because 1, not all of them are going to sell, and 2, they take a little longer to sell. And some of these people might have to come into reality that, the market's not the market it was a while ago, so.
Mhm.
Yeah. But anyway, hey, it's going to be a great time to be in the business. And if you just go out and implement some things and get it to work. Now, I would invite all of you to come to my 12-hour new agent class, which you have to take anyway. You might as well take it early on. I'll be doing some right after the first of the year. Keep in touch. My specialty is helping new people get up and going quickly. So Dan and I appreciate it. And Brent, thank you for being here tonight to fill in for Dan on the technical part of things. Don't hesitate to call if I can help you, 801-556-8000. However, it is considered entirely inappropriate to call me during the exam itself. I know I could be the most help to you. Go for B, but we'll get us both in a lot of trouble. So don't do that, but call any other time, okay? Thanks for being here tonight, and I hope all your people you tried to elect won. But we'll find that out probably in the coming days.
I couldn't read, so I just guessed. I'm just kidding.
Yeah, okay. Well, if you're a good guesser, that'll work too.
Thanks, Rick.
Thanks for being here tonight. See you guys later. Bye-bye.
Bye.